morning and welcome to the Saxo Bank Morning Call. It is Thursday, June 13th, 2019, and I want to start off today with the situation in Hong Kong. Yesterday in the morning, we were so distracted by all the movements on the street, protests, riots, whatever the various sides are wanting to call this. It's pretty heavily affected the Hang Seng market. You can see here a chart of the Hang Seng index where we saw the last 2 days of volatility. Pretty steep correction there, and luckily we have with us in the studio this morning again Kay Peterson from our Singapore office, and you've also lived in Hong Kong and have a few contacts out there. I think you had a pretty interesting perspective, just not just on this whole extradition issue that was the immediate apparent cause of the protests.
Yeah, I mean, exactly. I think, as in a lot of things, there's the surface and there's what's like structurally kind of the currents that are beneath it, right? And this is kind of the same thing we've actually been talked about for actually quite a few quarters here at Saxo in our quarterly pieces and Steen Jacobsen, and that is a lot of this is discontent that has actually been brewing for a long time, and it basically goes back to the same kind of global themes of inequality, a big segment of the population not having access to jobs, not having access to housing, and the same kind of opportunities that a lot of other people would take for granted. And this has kind of been that last straw, if you will, right? So it's not just that extradition, it's a lot of Hong Kong residents actually feeling that the Hong Kong government has actually been failing them for quite a long time, too cozy relationships with the real estate tycoons, and so on. So it's a lot more kind of complicated than it just kind of looks.
And I'm sure on the real estate issue, a lot of mainland money must be flowing in and aggravating housing prices, which then prices out locals. That's been the issue in a lot of places around the world, from Vancouver in Canada to Sydney in Australia. So Absolutely. An interesting angle in that, and worth considering certainly as we see what happens next. And we don't know what's going to happen next. There's no
So it's totally dynamic. What we're hearing from our office this morning is it's kind of quieted down today. There's people kind of getting off the streets. Have been on the streets for 24-hour kind of plus. We also know the government office where I think the debate was supposed to happen seems to be shut down. Whether that's shut down for the rest of the week or not, it's super live. Okay. So we'll have to wait and see how it kind of goes.
Okay. Other thing we need to get to this morning before anything else is that our commodity strategist, head of commodity strategy, Ola S. Hansen, you have a webinar today, and what are you going to be talking about there?
Well, I just put up a slide here where you can see some of the highlights, and clearly it's been a very key, interesting month we had. So we're going to take a look at this growth worries and heightened U.S. rate cut speculation, what kind of impact that's having on some of these key commodities, speculators where they positioned right now, and also what are we doing with U.S. crop after this worst planting season on record, and finally just taking a look at some of the opportunities within the rare earths that's received a lot of attention recently with the heightened trade war spat between the U.S. and China.
The other thing, and more specifically overnight, and then suddenly this morning your chart is already out of date within minutes. We had a very ugly sell-off in crude oil yesterday.
We had another one. About? Yeah, we had another one, and it's interesting if you look at the chart here. You can see how these are the red arrows are basically the last 4 Wednesdays when we had inventory reports out, and you can see during these 4 days we've had a combined drop-off of $8.50. During that time, oil is down by around $9. That's now only down by around $7 because, as you mentioned, John, just early this morning within the last hour, there's been some reports from close to Oman. There's been distress signals from a tanker. We don't know if it's a cargo ship or a tanker, but obviously straight away the market gets nervous, and we've seen the market spike higher. But just returning briefly to the chart, the reason why the market is getting nervous is because this the chart which is showing crude oil inventories is just simply not going in the direction it's supposed to be going this time of year. Stocks are rising. Seasonally, it should be lowering because refineries coming out of maintenance. They're brewing gasoline for the driving season. It's not happening.
What's is it just this shale oil that's hard to refine? So they're kind of building up stocks of that because we've seen such an acceleration there, or
it is the phenomenal rise in crude oil production, which is doing the main thing here, and just also it seems like the gasoline demand is not as strong as it was last year.
That's an interesting economic sign. If so, of course, Americans like to drive around a lot, and that's if activity is decreasing, that's one place you would see it. All right. Also overnight, we had the Australian jobs numbers. This is seen as quite important as the RBA has linked its plans on easing the schedule at which it will ease to the state of the jobs market. I thought the headlines, some of the headlines on the employment report were a bit misleading. I have a chart here showing how difficult it is month to month to interpret these figures. You can see how strong the tendency is towards mean reversion. So if you have a massive growth in payrolls one month, it results in a massive draw the next month. I will point out the last 2 months have actually been quite strong, but the spin overnight was that almost all that growth was in the part-time jobs. And you can see here I've drawn a green arrow showing that the tendency, the moving average, was tending upwards into let's say early 2018, and since then you could argue it's tending downwards. And now that we have two positive prints in a row, I would suspect that the June cycle will be ugly. I think we can ignore the unemployment rate rise, which was overnight. That got a lot of attention. It's because we have a big rise in the participation rate, which is good news because that means more people are supposedly entering the market. I think it's just tough to get a draw beat on this from month to month. In any case, let's look at how the market is taking this. We pointed out Euro Aussie yesterday. We pointed out we took the long signal on our breakout model on that closer initial break above 162.50 earlier this week. And now actually we are trading above the highest daily close since late 2009, almost 10 years. A pretty interesting development there as we're seeing the weak Aussie. We're seeing as well Aussie dollar hitting towards those lows. And we're seeing Australian rates. Look at that 2-year rate. It's gone down from over 200 basis points late last year all the way down to 100 basis points. And one of the reasons perhaps that the Aussie dollar hasn't fallen more profoundly is that actually the declines in the US 2-year rate, of course, with this turnaround in the Fed, has easily kept pace with that. So we're actually just in spread terms trading in the same range, about negative 75 basis points, the Australian 2-year relative to the to the US 2-year rate. Interesting graphic. I'm not sure what you're seeing there on your screen. Let's get back to the pretty interesting because we're looking at the highs of the cycle once again, Ola, and this is kind of despite, we're not making dramatic new highs highs of treasuries, low in yields. We're not making any dramatic dollar situation going on here. Risk off has been pretty shallow, a little bit of risk, a little bit of consolidation there, but gold is
and I'm a little bit surprised that we haven't seen a deeper correction than what we've seen so far. If you take a look at the chart, the first possible opportunity, it's slightly hidden by the local, but you can see we touched just around the 1319, which is the 38.2% retracement of the latest rally up. Normally, it comes at a time where, if you look at the sensor graph, we had a record amount of buying from hedge funds up until last Tuesday. That probably continued up until Friday. So a massive amount of new longs in the market, which obviously just looking over the shoulders, just getting a little bit worried if there is any retracement. And that retracement we saw earlier in the week really stopped us at the first given point, so given opportunity. So that does indicate we got some underlying strength still. So, but again, we got a wall of resistance.
There's all those layers stretching back
all the way up to 1390 almost, so between 1350 and 39. So we need some additional, I think, ammunition really to attack that.
And Kay, out in Asia, I mean, how much excitement are you have a better sense of what the clients are actually doing? How much is this latest move? Of course, we had the initial move in late 2018, and now we're reapproaching. How much anticipation is there around gold?
Well, I mean, gold's always massive, right? Yeah. Obviously, cultural issues also with India and China and so on, and store value historically, right? I think gold's been exceptionally tough to trade this year, at least from a tactical kind of perspective. I don't know, a lot of our clients and also peers have been very, very kind of frustrated with that. Structurally speaking, I think everyone understands we're seeing record central bank buying, the biggest since '74. That is continuing this year. So I still think from a strategic perspective, people understand you should have a core long position, especially if we hold above 1250, which I still believe is kind of the 200 weekly moving average. But I think they've really struggled. I'd be surprised if a lot of them have actually caught the majority of this move up, because we've had such many kind of fake breaks both to the up and to the downside, right?
Okay, interesting. And I wanted to cover this issue. I know there aren't, we're not a massive grain trading shop, but I just think it's one of those issues we need to track. This corn price in the U.S. is poking back towards those highs. It
is indeed, and I think we're seeing rising prices. We're seeing rising prices in China as well. We just saw the inflation number come out. We're very much impacted by rising pork prices. But take a look at the chart here. We had the WASDE report out early in the week, and it really confirmed that it confirmed that this significant damage to U.S. corn crops this year. It's probably slightly difficult to see, but we had some significant down revisions, even beating what the market was expecting, and that's keeping soybeans supported here at this stage. And we're seeing a follow through to the other markets, wheat and corn as well. Wheat and soybeans. Wheat is a global market, so that's more impacts well also by what's happening in Eastern Europe and in Europe. And so far the weather is pretty good, so potentially a bumper crop. So that may limit the upside. But overall, I think agricultural products, we probably should keep an eye on that as a sector.
And we will know how much damage this armyworm infestation may have done out in Asia as well. So that could be an issue that aggravates two continents were having issues with the corn crop. Interesting issue to track. Of course, cost-push inflation is the most uncomfortable kind, and it will draw money away from other sectors if that is something that continues to go higher. Let's look at our macro calendar for today, the rest of the week, and longer term. Just want to point out the S&B today. It's been interesting to hear how stout their defense of the Swiss franc from further strengthening will be after Euro-Swiss recently tried below that 112 area. The line in the sand may be a bit lower, but I suspect they'll be a bit pounding on their rattling the cage, if you will, on intervention. And then we look for that OPEC monthly report. Is there a lot of anticipation around that, Ole, the monthly?
No, it's just once again they're looking for OPEC's take on all this demand growth. Whereas we did see the EIA earlier in the week did downgrade their demand forecast, but they also downgrade actually the non-OPEC supply because they're seeing a downshift in shale oil production because of the lower prices. But I think the main impact is really they want to see OPEC's take on the impact on growth going forward.
Okay. Now let's also look at those weekly figures, those weekly jobless figures, I think in the U.S. are going to start picking up interest increasingly, for me at least, because we saw that weak payrolls report for the May cycle, but really historically these weekly jobless claims report really starts to show notable signs of picking up. We have sort of apparently clearly established a bottom for the amount of claims, but are we rising or are we not? I think that'll be an interesting one to track in coming weeks. I think that is one of the key indicators you're going to see start to turn pretty significantly if we are headed towards a U.S. recession. And then we have, I think I'll skip the rest of the stuff this week. I just wanted to point out I added June 20th to 21st. That is next Thursday and Friday. Of course, the FOMC meeting, massively important. We'll talk more about that every day until then. But this is already, we're seeing it. Let's recall the EU Commission, leader of the EU Commission is appointed by EU leaders, by the European Council. So this is something that is already, even though that person will be taking office November 1st, it's not something that's established, or it's something that's already established. The candidate is decided on late next week. And I think this will send profound signals about where we're headed politically within the EU. I won't run down the candidates here, but look out for that. That'll be an interesting debate and about the result of that process late next week. That's it for today. We'll be back tomorrow with the Saxo Bank Morning Call. Thanks for joining.